Hello and welcome to the first Wealth of Advice market update of 2023. Happy New Year to everyone who watches these updates. Definitely hoping that this year is going to be much better than 2022. And so far in the first couple of weeks of the year, news stories are coming through, markets are going up. That suggests it might be. First bit of news, Wealth of Advice's annual client seminar is going ahead on the 27th of January. That's at Durham Cricket Club, just along from us on the A1. Thankfully, a load of clients have responded to say they're going to attend. I think we've got 98 confirmed attendees so far. The room it's a big room, hosts around about 110 people, I'm led to believe. So if there's anyone who hasn't yet registered their interest to come to that, please do so quickly. It's less than a fortnight away now, but great news that almost 100 people have registered so far. As ever, we will be recording bits and pieces from the day, so any clients who can't make it, don't worry, you will still get updates after the event to find out what's going on. So let's kick off this first update of the year with some market news. On Friday, I was pleased as I was driving in to hear a report on the radio to say that the UK hadn't or was unlikely to go into a recession at the end of 2022 as a result of November's figures coming through, which was great news. We saw the Sky news story putting on the screen now. The recession's in doubt as economy achieved surprise growth in November. So it just goes to show, if you were watching the news the last few months of last year, you were led to believe the World Bank, the Europeans, everyone was believing the UK was already in recession, and there you go, the numbers come through, it actually held up. The next chart you can see on the screen now shows a breakdown of how our GDP is put together, and it was the services sector that grew in November, which helped us avoid this recession. So the only way we will be classed as going into a technical recession, which is 2 negative quarters of growth, will be if December's figures are worse than minus 0.6. Given that it was Christmas and we're all generous people in this country and everyone was out spending, you would expect that we're not going to see a 0.6% reduction in December. So therefore, we've avoided this technical recession, which is great news. Markets will like that. There was always the fear that the UK was going to have the deepest, longest recession of all the developed economies. Well, hopefully that isn't going to happen. In other news, which I think is obviously important when we talk about inflation, we're going to do quite a bit on inflation as we go on. People are starting to see petrol prices come down. They've hit the lowest level in nearly a year. Spiraling food prices, they appear to be coming down. Even though I spoke with my dad on Saturday, who was aghast that when he went into Asda on Friday, he couldn't believe the price of certain items. And then as he was talking, I was reading an article. Heinz were getting absolutely slated for the price of their beans going up by 21 pence. And supermarkets are expecting a big negative backlash from customers as they're going to announce really, really big profits in the coming weeks and months. If you're an investor and you invest in UK stocks and shares, any stocks and shares around the world, we've been saying for a while now that companies have been charging as much as they possibly can because in inflationary times they can get away with it. Well, that will result in higher profits. Higher profits should equal higher share prices. So although you are feeling that you're getting ripped off at the till, hopefully you will see that the value of your pension investments will go up as these companies do make good profits. So we're now going to look at the GDP growth outlook for the coming 12 months. What will 2023 be like from an economic growth point of view? All the experts are suggesting that over the next 12 months, economic growth will be lower. This is kind of an obvious knock-on effect from the fact that central banks all over the world have tried to curb growth in an effort to contain inflation. It's expected, or has been expected, that the US was going to be less exposed to inflation risk, i.e. their economy was going to perform the best and be strongest relative to UK and Europe. So if we're already seeing that the UK figures were better than expected, the economy's held up well there, then hopefully we see similar things in the US, and we'll see that their markets bounce up as well. The US Federal Reserve's biggest enemy is inflation, and they're not bothered that they're going to cause a reduction in GDP growth as long as they get inflation under control. So we've still kind of got that going on in the background, and what you're seeing in the equity markets is a lot of volatility. One day there might be a positive news stories and the markets go up by 1%, 1.5%. The day after there's something negative comes through and they fall down. So we're keeping an eye on that, but the general trend over the last few weeks has been that markets have gone up. The two charts that we're going to put on the screen now show what GDP growth forecasts look like. And you can see that the trajectory of GDP growth has obviously come back down following the post-COVID recovery. Obviously, that's been caused by the fact that central banks have rose interest rates, inflation's gotten out of control. But what then's happened is with these soaring interest rates and inflation, is that consumer confidence and business confidence has suffered a little bit. Speak with lots of clients who've said things like, well, we don't know what's going on in the world, so we might put off spending this or spending that. But if you think about that in business, there's a lot of big companies out there who are holding back on big infrastructure spends at the moment as confidence is a little bit lower. So what we need to see is things just calm down a little bit, inflation come under control, interest rates peak and hopefully go down eventually, and then you'll see that confidence may come back. So we now look specifically at the topic of inflation. In 2022, inflation was one of the main drivers of the negative performance we all saw in our pension investment returns. And central banks the world over have a policy now of trying to get inflation under control. You can see the chart on the screen right now looks at US consumer price index through 2022, and thankfully, as you can see, it looks like it started to peak, and by the end of December the figure that's quoted there was 6.5%. So when we look at the outlook for inflation in 2023, it's good that we're showing that it has started to decline from its peak levels already, but we believe that it's going to stay structurally higher for longer. This is because inflation has broadened from where the inflation's coming from. It's not just from the energy problems that we saw in the world last year and the supply side disruptions caused by China being in lockdown and the wage price growth that was coming through. Well, the other factors that are going to keep inflation maybe higher than expected is the transition to net zero is going to require investment in lots of areas. That's going to be big spends. The restructuring of the European energy supply market, Germany no longer getting its energy from Russia, looking to get it from the US. That's going to mean higher costs to get new refineries and such like implemented. So there's lots of reasons why inflation will remain higher than what it had been, say, over the last 30 odd years. But that was when inflation had a target of around about 2%. It's 6.5%, the US CPI we saw there at the end of December. If that can go below 4%, then I think central banks will be much, much happier. If they can get it down closer to 3%, then I think they will feel this is almost mission accomplished. To get it less than 3, closer to 2, I don't know how long that'll take, but certainly not in the short term, and it'll therefore take a little while to get the inflation shock to wash its way through the system entirely. Now looking at interest rates, you can't really have a conversation right now about interest rates without talking about inflation. We've spoke about inflation so much, it seems, over the last few months, and obviously everyone watching this will be aware that central banks have rose interest rates in an attempt to curb inflation. The Federal Reserve in America has been hell-bent on bringing inflation down to the point where they weren't bothered, or they aren't bothered, if that's going to affect economic growth in the future. They want to rise interest rates to curb growth and see inflation come back down. So over the next 12 months, the outlook for interest rates remains higher, but although interest rates might continue to rise in the short term, it's certainly felt that the peak is in sight. When they start to come down, we don't know. So now look at these two graphs on the screen, which looks at the interest rate outlook. As you can see there, across in the US, it's expected that rates will go up a little bit more in 2023, then peak and come down, certainly through 2024, before maybe rising again towards the end of the decade. The UK chart shows there that rates will continue to rise a little bit for the rest of this year and again start to come down. This is good news overall. You're already starting to see banks in the UK start to create a little bit of a price war over long-term fixed rate mortgages by bringing the rates of those down. In the past, people have believed that central banks will come to the rescue in previous crises to get the economy moving again. But that should be remembered, that was in a period when inflation was in check. So right now, if we do enter a recession in 2023, the thought that the Federal Reserve might come out straight away and reduce rates straight away might not happen like it did. I know on a previous update we said there was a fund manager we heard speak up in Edinburgh who said you might see rates start to come down at the end of Q1 2023. I think he was being a little bit ambitious. The Federal Reserve is clearly saying that it wants to see what happens with inflation before it starts to reduce rates. But when you look at those two charts there, and you can see what the overall long-term rate outlook is, you can see that they're not going to go to these elevated levels where you might have thought they might go to 8-9% like they were in the 1980s. But if you look back on the chart, if you go back to 2006, 2007, where interest rates used to be before we hit the financial crisis of 2008. Interest rates are only going back to long-term normal levels. It's not normal to have interest rates at 0%. So hopefully what we will see in a year or two is rates go to what should be regarded as a long-term normal rate level. So we now come to the end of the presentation where we go through how stock markets have performed recently. As I said, the summary points to take from what's been going on in markets recently is that they're overreacting, I think, to every bit of news story, whether it's positive or negative. And as you can see on this first chart of how markets have performed over the last month, you can see how they went down in mid-December to Christmas. We had a little bit of what we were expecting to be a Santa rally, as it's called. That went up until the 21st of December. And then things obviously remain flat over what the Americans call the holiday period, when everyone is away from their desks. Come back after Christmas. You can see the FTSE 100 there from the 2nd of January has rose quite far away and ahead compared to the other two indices. So the FTSE 100 over the last month is the best performing index on there. And also over 12 months, FTSE 100 is up 7% over the last 12 months, whereas the S&P and the MSCI World Index is still in negative territory over that period. But again, to reassure clients who might not have been invested for that long with us, if you look at the long-term performance, market indices performance over the last 5 years, even taking into account wars, COVID, trade wars with China, etc., the US market is up 71% over 5 years. The MSCI World Index is up 52.5% over 5 years. And the little FTSE 100 there at the bottom, 21.4% over 5 years. So when clients say to us, why don't you invest in the market that's performing the best right now? FTSE 100 is doing well at the moment, but it's dominated by the oil companies and the mining stocks. Is that really going to outperform the S&P 500, the MSCI World Index over 5 years? I would be surprised. The S&P is dominated by the biggest companies on the planet, who you will hope come out of this period still in a very strong position with good share prices that are going to go up. And as ever, we think that we've got our clients invested in the right places. We made some key changes during 2022 to our model portfolios. Those clients who invested with Royal London and other such strategies have seen that those fund managers have made some key changes as well. And hopefully, as I say, 2023 is a much better year for everyone. So thanks again for listening to another Wealth of Advice Market Update. We'll be doing these as ever throughout the whole of 2023. Look forward to seeing a good number of clients at our event at the Cricket Club on the 27th. And as ever, if anyone has any questions, queries, please don't hesitate to get in touch.